With increasing clarity, it's become evident that simply printing more money isn't the cure-all solution many hoped for. According to Robert Kiyosaki, watching demographic shifts is like peeking into a crystal ball. It's through these changes we can predict upcoming economic patterns. While many might view the current financial bubbles in real estate, the stock market, and bonds as an aberration, Robert believes they're clear indicators that people are beginning to recognize the inherent flaws in our system. A staggering $300 trillion in financial assets could potentially vanish, not to reappear for years. Yet, as history shows, this isn't the first time experts have sounded the alarms. Back in the 80s, when most eyes were on the rise of Asia, Kiyosaki foresaw the massive economic boom in the US, driven by the spending habits of the baby boomers. But let's rewind for a moment. The surge from 1983 to 2007 was historically significant, driven by the spending power of this generation. However, the subsequent slowdown in 2008, despite its impact, was merely the tip of the iceberg. The continuous printing of money, year after year, was less of a solution and more of a band-aid on a growing wound. With trillions pumped into the economy post-COVID-19, it's become clear that such artificial stimulants can't last forever. Welcome to Wealth Builders Wisdom. For our avid viewers, if you're finding these insights valuable, don't forget to subscribe for more enlightening content. A fascinating aspect Robert highlights is the generational and technological cycles that punctuate history. Every 45 years or so, there's a noticeable shift. With baby boomers at the helm, the world witnessed unprecedented growth. But after 2007, a noticeable downturn began. The economy's natural resurgence, powered by the millennials, won't manifest until roughly 2023 or 2024. But before this new dawn, the world will experience the painful collapse of current unsustainable financial systems. It's an era of stark contrasts. On one hand, we have the wealthy elite, who've profited immensely from these financial bubbles. On the other, we see the average individual, struggling to keep pace in a rapidly shifting landscape. Sadly, this unbalanced growth, fueled by constant stimulus since 2009, has had its toll. As history has shown, financial bubbles, however grand, always burst. One might wonder why such clear patterns are often ignored by the masses. It's human nature to cling to hope, to trust in booming markets, and to believe in the words of popular figures who reinforce our biases. The majority have huge stakes in this financial game, and as such, they gravitate toward those who promise perpetual growth. But real growth, as Robert suggests, isn't achieved by mere financial manipulation. Understanding these generational impacts is crucial. The decline from 1961 to 1975, marked by Generation X, led to the economic slowdown we've been experiencing since 2008. The millennials, born subsequently, are the beacon of hope. However, even their economic influence, though significant, will only bring us back to the levels seen during the baby boomers era. Such a spectacular boom, as witnessed between 1983 to 2007, might never recur. What's in store for Generation X? While they've been at the heart of this slowdown, there's a silver lining. As asset prices eventually tumble, they'll be in a position to invest wisely, securing their futures amidst more realistic market valuations. Robert Kiyosaki's insights serve as a timely reminder of the cyclic nature of our economic system. Understanding these patterns, preparing for them, and adapting to changes can ensure financial security across generations. In today's complex financial world, many are left pondering where to place their hard-earned money. The global markets are at a pivotal point, with bond markets showcasing historically low interest rates, and stock markets exhibiting astonishingly high valuations. If you choose to invest now, the returns are modest, hovering around a mere few percentages annually. However, the real magic happens when markets stabilize and offer fair asset prices. Interestingly, we're witnessing a trend that is swiftly transforming the world of work. The ability to work remotely and avoid the daily commute has increased overall productivity. Yet, the spending habits of millennials have ushered in a palpable slowdown in comparison to the lavish expenditures of the baby boomers in their prime. Instead of facilitating debt restructuring during this change, many governments are holding on to bad debts accumulated during the illustrious boom period of 1983 to 2007. Such an approach stifles innovation and obstructs the free market capitalist system, which has been the backbone of our prosperous modern society. It's imperative to remember, when you avoid the natural economic process of growth, expansion, and eventual slowdown, you're merely delaying the inevitable. Avoiding recessions is like avoiding sleep. It's unhealthy and unsustainable. Fast forward to today, we have a staggering estimate of $600 trillion in global financial assets. That's a colossal 7 times the global GDP. This overinflation indicates a looming correction. When this bubble bursts, money will naturally gravitate towards the safest options. Predominantly top-quality real estate and trustworthy bonds like the US 30-year Treasury. Before we delve deeper, if you're finding this content valuable, don't forget to hit the subscribe button for more insights on building your wealth. Now, let's understand this further. Back in 2008, we saw the tremors of what could be likened to the financial events of 1929–30. Financial assets plummeted, but where did that money shift? It sought refuge in the safest bonds and the most stable real estate segments, primarily multifamily real estate. The logic is straightforward. Even in dire economic conditions, people will always need a roof over their heads. However, the star of this protective strategy is undoubtedly the 30-year US Treasury bond. With the US being the best-equipped nation to weather an economic storm. Compared to its European and Asian counterparts, this bond is a beacon of reliability. But remember, always be on the lookout for shifts in global power. While North America might be a dominant force now, East Asia, especially countries progressing towards India, is poised to take the baton in the foreseeable future. A curious phenomenon is observed with bonds. When interest rates decline, the value of bonds ascends. If you had secured a bond with a higher interest rate and the current rate plummets, your bond's value skyrockets, making it an enticing proposition during inflationary periods. Speaking of inflation, there's a widespread myth that we're on the brink of hyperinflation. However, the truth is quite the opposite. Inflation rates have reached their peak, and as the market starts to correct itself, we'll witness inflation rates plummet. Mark my words, in the foreseeable future, high inflation will be a thing of the past in developed nations. In conclusion, timing is the essence of smart investing. It's not about when you sell, but when you buy. As we navigate through these unpredictable financial times, the savvy investor knows to capitalize on opportunities when the market is low. For real estate enthusiasts, multifamily housing remains an evergreen option. Remember, the fundamental principle of economics remains: there's no free lunch. As we witness trillion-dollar stimuli failing to stave off recessions, it's a clarion call to realign our investment strategies and brace for the inevitable. If this was valuable to you, don't forget to like this video and subscribe to Wealth Builders Wisdom for more expert insights.